Feeling overwhelmed? Let's be honest, you're supposed to. The world of finance, with all its noise and jargon, is designed to be confusing. It's built to make you feel like you need a PhD in economics just to get started. But here's the secret they don't really want you to know. For decades, the most successful long-term dividend investors have used one simple number to cut through all that chaos. It's a number that acts as a financial stress test for a company. It tells you, almost instantly, whether a company's dividend is a reliable source of income or a trap waiting to spring on your portfolio. You don't need to understand everything. You need to understand this one thing first. Today, I'm going to show you exactly what that metric is, where to find it for free, and how to use it to start selecting solid dividend stocks for 2026. The problem: paralyzed by complexity. You've heard the advice 1,000 times. Invest in dividend stocks for passive income. It sounds so simple, right? You buy a piece of a great company, and it pays you just for owning it. So you decide to finally do it. You look up a stock, and you're immediately hit with a wall of data. Analysts are debating the PE ratio, the debt to equity, the free cash flow, and the earnings per share. Someone on a message board is arguing about alpha and beta. It's like trying to drink from a fire hose. So what happens? You freeze. You're paralyzed by the fear of making the wrong move, of missing some critical piece of information that everyone else seems to understand. This is the number one reason most people never start. It's not a lack of money, it's a lack of clarity. But what if we could filter out 99% of that noise? What if, instead of trying to become an expert on everything, you could just become an expert on the one thing that truly matters for dividend safety? The solution: the one metric that reveals the truth. The single most important metric for a new dividend investor isn't the dividend yield. It's not the stock price. It's the dividend payout ratio. That's it. If you only have time to look up one number, this is the one. So, what is it? Simply put, the dividend payout ratio is the percentage of a company's profit that it hands out to its shareholders as dividends. Think of it this way. Imagine you own a bakery that made $100,000 in profit this year. If the bakery decides to pay out $40,000 of that profit to you and the other owners, its payout ratio is 40%. The other $60,000 is kept by the bakery to fix ovens, open a new shop, or save for a rainy day. That part is called the retention ratio. This one number tells you a powerful story. It shows you how committed the company is to its dividend, but more importantly, it tells you if that dividend is sustainable. It's your first and best line of defense against a dividend cut, the ultimate nightmare for an income investor. So, how do we actually use this thing? It's a simple 3-step process. Step 1. Where to find the payout ratio for free. This is the easy part. You don't need any fancy, expensive software. Simply open your web browser and navigate to a free financial site such as Yahoo Finance, Google Finance, or Seeking Alpha. Type in the ticker symbol of any dividend-paying company you can think of. Let's use Coca-Cola, KO, as an example. On the Statistics or Key Metrics page, you'll find a line that says Payout Ratio. It's right there, a single percentage. This takes less than 30 seconds. Step 2. What is a good payout ratio? Now that you have the number, you need to know what it means. While there's no single perfect number for every single company, a healthy and sustainable payout ratio for most stable companies generally falls between 30 and 60%. Here's a simple cheat sheet. Below 30%. This is a very safe payout. It means the company is keeping most of its money to reinvest in growth, which can lead to even bigger dividends down the road. You'll often see this with growing tech companies, such as Microsoft. 30 to 60%. This is the sweet spot. It shows the company is mature and profitable enough to generously reward its owners, but it's also keeping enough cash to handle problems and grow the business. This is home to many blue-chip, household name companies. 60 to 80%. Now we're getting into the yellow flag territory. A payout ratio this high can be okay for incredibly stable businesses like utilities, but it leaves very little room for error. If profits dip even slightly, the dividend could be in trouble. Above 80%. Big red flag. A payout ratio this high is often a major warning sign. It means the company is paying out nearly all, or sometimes even more than all, of its earnings. This is often unsustainable. The company is starving itself of cash, and the dividend is at a high risk of being cut, especially if the economy gets bumpy. Let's look at a couple of famous companies to see how this plays out in the real world. First, Procter Gamble, PG. This is a classic dividend stock that sells products we all buy. Tide detergent, Crest toothpaste, and so on. If you look up its payout ratio, you'll usually find it comfortably within the healthy 50 to 60% range. This demonstrates that P&G has been increasing its dividend for over 60 years, and doing so responsibly. It pays shareholders a nice dividend, while also keeping billions to innovate and grow. That is the definition of a safe dividend. Now, for a warning that was written on the wall. In 2023, the tech giant Intel, INTC, announced a massive 66% cut to its dividend. In the period leading up to the cut, the company's payout ratio had climbed to unsustainable levels, reaching nearly 80% of earnings in 2022. More concerning, Intel was actually paying more in dividends than it generated in free cash flow, a clear warning sign that the dividend was on shaky ground. Investors who were chasing the high yield were caught off guard, but anyone who glanced at the payout ratio could see the warning sign flashing bright red. Is this starting to click? Do you see how this single number can provide you with so much more clarity and confidence? If you find this helpful and want more simple, no-nonsense guides to building wealth, do me a quick favor and hit the subscribe button. My whole goal here is to give you the tools to take control of your own financial future. Now, I can already hear the experts typing in the comments, but wait, it's not the only metric that matters. And you know what? They're right. Calling the payout ratio the only metric is a simplification, but it's the right simplification to start with. It's your most critical filter. Once you've used the payout ratio to ensure a dividend is safe, you can then examine two other key metrics to get the full picture. I like to call this the Dividend Trinity. First is the payout ratio. We just covered this. Is the dividend sustainable? This is your foundation. Second, the dividend yield. This is what you receive immediately. It's simply the annual dividend divided by the stock price. If a stock costs $100 and pays $4 per year, it has a 4% yield. This is your immediate return. And the third is the dividend growth rate. This shows you how much the dividend is increasing each year. A company with a 3% yield but a 10% dividend growth rate will be paying you much more in a few years than a company with a 5% yield and zero growth. This is how your income really starts to snowball. Think of it like a three-legged stool. The payout ratio is the leg that makes sure the whole thing doesn't collapse. The yield is how high the stool is today, and the growth rate is how fast that stool is getting taller. You want all three for a genuinely excellent dividend investment, but you should always check for that first leg of safety before you even think about the other two.
So why is this laser focus on the payout ratio so crucial as we look ahead to 2026? Economic forecasts are hinting at a period of slower growth and lingering uncertainty. When the economy is booming, even shaky companies can appear strong. But when things get choppy, the disciplined companies with sustainable finances are the ones that not only survive, but thrive. In a tougher economy, profits can shrink. A company with a 95% payout ratio has no cushion. A small drop in earnings could force a dividend cut. But a company with a 40% payout ratio can see its earnings fall by half and still comfortably afford to pay its dividend, and maybe even increase it. Focusing on the payout ratio in 2026 is your best defensive strategy. It's how you build an all-weather portfolio that doesn't just survive a storm, but keeps paying you right through it. For years, the financial industry has profited from making investing seem way more complicated than it needs to be. But it doesn't have to be that way. You don't need to be a Wall Street wizard. You don't need to read every dense financial report. You need a starting point. a simple filter to weed out the bad apples and find the healthy, reliable companies. And now you have it, the Dividend Payout Ratio. Your journey to becoming a confident dividend investor starts right now with one number. So here's a challenge for you. Pick any dividend stock you've ever been curious about. Go to a free finance site, look up its payout ratio, see what story it tells you. Is it in the safe zone? Is it a yellow flag? Is it a big red flag? You now have the tool to answer that question for yourself. One quick reminder, the information in this video is for educational purposes only and should not be considered as financial advice. Always consult with a qualified financial advisor before making any investment decisions. And remember that past performance doesn't guarantee future results. Thanks for watching. If this video helped cut through some of the noise for you, please subscribe and turn on notifications. I post new videos every week with clear, actionable steps to help you build long-term wealth. And be sure to check out my next video where I break down 5 dividend stocks with rock-solid payout ratios that I'm watching for 2026. Keep it simple and happy investing.